All right, let's just jump right into it. Welcome to today's Explainer, where we're going to take a really rigorous look at the methodological limitations of the income method for our grade 12 SYSC syllabus. You know, macroeconomic measurement, it's rarely a perfect science, and the income method is honestly a prime example of where perfectly neat textbook theory just violently collides with real-world friction. Let's break down exactly why capturing national wealth is just so extraordinarily complex. So here's our academic breakdown for today. We're looking at the income method premise, the big structural challenge with mixed incomes, the whole accounting controversy around national debt, the data gap in underdeveloped economies, and then we'll wrap it up with a methodological summary. All right, starting off with part one, the income method premise, that classic textbook foundation of summing up factor incomes. Okay, so we've got to establish our baseline first, right? Basically, this method calculates national income by theoretically adding up all the incomes generated during production. We're talking compensation of employees, operating surplus, and, here's the tricky part, mixed incomes. To really grasp our first major limitation, we have to strictly define what mixed income actually is. Essentially, it's a combo of labor and capital income. Think about own account workers, unincorporated enterprises, local farmers, plumbers, sole proprietors. These folks provide both the labor and the capital. Their earnings are this hybrid mix. I mean, they aren't paying themselves a formal corporate salary or declaring formal dividends. So right out of the gate, this hybrid nature creates a massive classification headache for national income accountants. Moving to Section 2, Structural Challenge Mixed Incomes. This is really the dilemma of the unorganized sector. So, when we actually try to estimate these mixed incomes, we just hit a massive structural wall. These incomes are heavily concentrated in the unorganized sector. Look, unlike massive corporations that pump out audited quarterly financial reports, your local tradesperson or small-scale farmer typically just doesn't maintain rigorous, standardized accounting books. It's just not happening. And because that bookkeeping is either totally non-existent or super informal, the data collection from these entities is structurally deficient. Basically, we are forced to rely on really broad estimates rather than hard empirical data. And as you can guess, that injects a pretty significant margin of error right at the foundational level of our macroeconomic models. On to Section 3, Accounting Controversy, National Debt. Let's examine the convention of state borrowing. Now, there is a very strict academic rationale for why we strictly and impartially omit certain financial flows here. Macroeconomic convention basically dictates that interest on the national debt should not be included. Why? Well, it operates on the assumption that government borrowings are used for consumption, or what economists call unproductive purposes. Remember, in national income accounting, we only want to measure payments that reflect the current flow of goods and services. Because the standard textbook convention assumes government borrowing is mostly channeled into immediate consumption or administrative upkeep, the interest paid on that debt, it's treated purely as a transfer income. It just transfers wealth from taxpayers to bondholders without actually generating any new tangible production in the current year. Maintaining absolute analytical neutrality here, it's fascinating to see how macroeconomic convention draws this sharp, definitive line between assumptions of private investment and government consumption. Think about it. When the private sector borrows, we just assume those funds are being utilized for productive capital investment, building a factory, buying new machinery, stuff that yields future economic returns and actually expands the economy's productive capacity. So boom, private interest is included. But government borrowing, that carries the strict assumption of unproductive consumption. Now, look, whether you personally agree with that assumption or not is honestly entirely beside the point for us here. Strictly, academically speaking, this specific assumption is exactly what justifies the complete omission of national debt interest from our calculation. Okay, so we've covered structural hurdles with mixed incomes. We've looked at strict accounting rules for national debt. Now we've got to step back and ask, how do these strict data collection methods fundamentally break down when we apply them to underdeveloped economies? Because honestly, this is where the income method faces its absolute most severe geographic test. That brings us to Section 4, the underdeveloped economy gap. This is why the income method faces such severe geographic constraints. The logic here is actually pretty straightforward. A methodology that is deeply reliant on formal tax infrastructure is inevitably going to falter where that tax base is practically non-existent. In standard macroeconomic practice, national statisticians rely heavily on formal income tax returns to figure out the aggregate income of a population. It makes sense, right? It's the most reliable, centralized data source we have. But in underdeveloped economies, the formal sector is completely dwarfed by the informal sector. only a remarkably small fraction of actual income earners are registered taxpayers. The vast majority of the population is operating entirely outside the tax net. So, the inevitable conclusion, the income method becomes severely limited in its accuracy and its application in these regions. I mean, you simply cannot use tax returns to measure national wealth if, say, 90% of your workforce doesn't even file one. It just doesn't work. Let's wrap this up with Section 5, Methodological Summary, our final academic takeaway regarding income distribution. So, look, while it is clearly imperfect, this method still provides just unparalleled insight into how national wealth is actually distributed. Yes, we face immense difficulties with the unincorporated sector's mixed incomes, for sure. Yes, the convention of omitting interest on national debt can seem pretty rigidly assumed. And yes, absolutely, the method is inherently handicapped in underdeveloped nations that lack a robust tax infrastructure. But despite all of these really profound flaws, the income method remains absolutely vital. It is literally the definitive methodology that allows economists to track the functional distribution of wealth. It tells us exactly what piece of the national pie goes to labor as wages and what piece goes to capital as rent, interest, and profits. And honestly, that distributional data is absolutely indispensable for shaping sound economic policy. So, I'm going to leave you with this final academic provocation. As economic structures continue to evolve, how must our macroeconomic accounting conventions adapt to capture the true hidden value of these unorganized, untaxed sectors? It's a massive puzzle for the next generation of economists. I mean, if the unorganized sector keeps growing in this digital, gig-based global economy, just relying on traditional tax returns and outdated assumptions simply won't cut it. Consider how future economists might solve these data limitations to capture the whole picture. Thank you so much for joining me for this deep dive into macroeconomic methodology. Stay curious, keep analyzing, and I'll see you in the next explainer.